If you are like most people, you have been told this your entire life. Renting is throwing your money away. Stop paying your landlord's mortgage, buy a house, and build equity. It is the ultimate path to wealth. But what if that conventional wisdom is wrong? What if buying a home can actually leave you poorer than renting the exact same house? To find the truth, we need to put aside the emotional attachment of painting our own walls. We have to examine the hard, unrecoverable costs of both choices. Almost everything we are taught about the housing debate relies on incomplete math and hidden assumptions that quietly drain your bank account. Let's look at two people, Ryan and Steve. They are both 32 years old, they live in the same city, earn $80,000 a year, and have saved exactly $80,000 in cash. Financially, they are identical, but their choices diverge. Ryan buys a nice 3-bedroom house for $350,000 to lock in some stability. Steve decides to rent a comparable home down the street for $2,000 a month to keep his options open. We are going to follow them for the next 20 years to answer one specific question. If two financially identical people make opposite housing choices, who actually ends up wealthier? Ryan starts by draining his savings. He puts down $70,000, a 20% down payment, and pays another $10,000 in closing costs. His entire $80,000 is gone on day one. Ryan's $2,653 monthly cost includes principal, taxes, insurance, and repairs. Steve's unrecoverable cost is his $2,000 rent. Ryan's payment is not entirely an investment. Only $230 pays down his loan. The remaining $2,423 goes to the bank, government, and insurance, gone forever. In month one, Ryan is actually throwing away significantly more money than Steve. Meanwhile, Steve still has his original $80,000 in the bank because he bypassed the down payment and the closing fees. Ryan's monthly bill is $2,653. Steve's rent is $2,000. Steve takes that exact $653 difference every single month and invests it directly into a diversified stock market index fund. This is the vital financial mechanism that makes renting work. It is only a competitive wealth-building tool if you treat those monthly savings as a mandatory, untouched investment. At 3 years, Ryan has $117,000 in equity, while Steve's investments reach $130,000. By year 10, compounding pushes Steve's wealth to $290,000, slightly ahead of Ryan's $254,000. At year 20, Ryan holds $535,000 in equity, but Steve's portfolio has surged to $750,000. The math shows that renting does not automatically equal throwing money away. When the capital is deployed correctly, renting and investing can build massive wealth that outperforms homeownership. But this perfect math assumes perfect human behavior. In the real world, human beings are not spreadsheets. This brings us to the discipline gap. Renting only wins if a person actually invests that $653 difference every single month. In reality, most renters lack Steve's robotic discipline. They spend the extra cash instead of investing it. A mortgage prevents that. It acts as a rigid, forced savings plan. The bank demands your payment every month, forcing you to build equity. This behavioral mechanism is why the average homeowner accumulates far more wealth than the average renter. For many people, buying a house is less about outsmarting the market and more about protecting themselves from their own bad financial habits. There are other trade-offs too. Ryan's wealth is heavily concentrated in one illiquid physical asset. If his local real estate market suddenly drops, his entire overall net worth violently drops right along with it. Steve's wealth is highly diversified across thousands of companies, and he can access his cash at the click of a button. Buying also carries massive entry and exit fees. Selling a home requires paying 5 to 6% in agent commissions. Those transaction costs are so heavy that buying generally only makes financial sense if you plan to stay in the home for at least 7 to 10 years. To calculate which option makes sense for you, use the price-to-rent ratio. This formula divides the home price by the annual rent of a comparable property. If the result is below 15, buying is highly competitive. If it is over 20, renting and investing the difference is usually the smarter financial move. The best choice is dictated by your personal time horizon and the specific math in your local market, not inherited cultural traditions. Ultimately, housing is a service. Both options are just different ways to pay for shelter. Renting is paying a fee for flexibility and zero maintenance stress. Buying is paying high transaction fees for stability and a fixed housing cost that protects you from inflation. Neither choice is automatically right or wrong. It depends entirely on how long you want to stay, how you want to live, and if you invest the difference.